Duminal Sambonani, welcome back to the Real Streetwise Financial Talk. Once again, this is your boy Calvin, your StrikeBait investor. Thank you guys for tuning in for this week's episode. Once again, I thank you for the love shown. The past two episodes were a success. Just to get some admin out the way once again, please note that this channel is sponsored by Click. Please follow the link down there. Click is an exciting company run by exciting people. It's doing exciting things out there. I promise you, you will not be disappointed. Another thing you need to note, guys, I'm not a financial advisor, I'm not a financial planner. I'm just a guy who's been in the game. I've made my mistakes. Now I want to make sure that you don't make the same mistakes that I made. Getting into it. So, in continuing with our credit series, guys, we move on. If you kumbula kahle, I said that this topic is broad and it's diverse and this one's cover. So my job is to bring you the relevant stuff, the stuff that's going to help you make your personal financial choices to better get you to that financial freedom stage. So if you think back, starting a topic that took you through how to improve your credit score. And then last week we took you through how to position your credit for you to be able to afford your first home. So namhlanje we're going to be talking about a very exciting topic, but because of how jam-packed this topic is, I wanted to actually make sure that you guys get as much information as possible and get your concentration on this topic. So I've split it into two parts. Today we'll go through the basics, the terminology and so on, and then the next week we'll then go dive deeper into it. The topic I'm talking about is how to pay off your bond in 5 years. And yes, guys, it's doable. It's possible. I know for a fact that it's possible. I've done it myself. I know a lot of people will disagree with me, telling me that this is a scam and so on. I'm saying, guys, just listen to me. The numbers don't lie. The numbers don't lie. If you run the numbers and you do this thing, the numbers don't lie. Like I said, guys, I've been in property for a while now, and I've been fortunate enough to stumble across some of these strategies, and they really do work. So to start off today's first part of the two parts episode, we will start you off by just talking about the different types of credit, because there's different types of credit. Because last week we discussed what credit is, we defined what credit was, and we defined the introductory elements to this topic. But now we want to actually break it down even further. We want to make sure that you have as much information as possible. And today I want to take you through the two types, or rather the types of credits out there. Because believe it or not, there's more than one type of credit. Abantu abaningi think that all types of credit ziyafana. For instance, a person sees no difference between a home loan and a credit card, and a home loan and a vehicle account, a vehicle loan. So today I want to break it down for you. I want to make sure that you've got the information that you can make those decisions, because it's all about you making the best decision for yourself. So today we'll be talking about the different types of credit. So there's quite a few types of credit out there, but they can all be categorized into three main categories, right? And that's what I want to take you through today, because if you can understand the different types of credit and you can understand how interest on them varies and how it's charged, then it's easier for you to position yourself for next week's episode, where we'll actually talk to how you can settle off your credit card, or rather settle off your bond, a 20-year bond, in literally 5 years, and it's doable. So different types of credit. So there are three main categories that we're going to take you through. The first one is installment credit. Yeah, I know, guys, my handwriting is terrible. I've been told that a lot of times before, but I mean, you know what they say about guys with ugly handwritings. So installment credit, I hope my spelling is right. You see, I always get confused. I never know whether installment credit is, installment has one L or two L's, but anyway, you get the gist of it. So installment credit is the first type of credit. The next one is revolving credit. And the last one is credit accounts. Right, so installment credit, revolving credit, credit accounts. Those are the three main types of credit out there. So what is installment credit? Installment credit is the easiest one to understand. It's your fixed term loan. If you think about a term loan, so for instance, whenever you have a fixed recurring repayment schedule, a fixed regularly recurring repayment schedule, you know from day one what you'll be paying for the life of this relationship. So for instance, on a personal loan, and it's a 5-year personal loan, and 5 years being 60 months, let's assume you're paying it every single month. You know for a fact that every single month for the next 60 months, you'll pay 2,000 rand as an installment, and I can predict namhlanje how much I'll be paying next year, assuming of course interest rates stay the same, they don't change. So that's your first one. So different types, the types of installment credit that you get out there is your home loan. Your home loan is an installment credit. Your car loan is an installment credit. Personal loan is an installment credit. Your student loan is an installment credit. So any relationship, any facility where the inputs are fixed, so it's amortized over a fixed period. That's another term that we're gonna go through today. These type of credits are amortized over the life of the instrument, but we'll go through that into more detail. Don't be confused by the words. Then revolving credit, it's all in the word. It revolves. So what the bank does is they make a limit available for you, and then you are allowed to make use of that limit, i.e. you're allowed to use the money and then pay it back, and then once you pay it back, you have access to the game. So revolver, you can use payback, use payback, and from that explanation, it's obvious you know what I'm talking about. I'm talking about your credit cards, your overdraft, your revolving personal loan. So those are your revolving credit. That's the second type. Then the third type is credit accounts. Those are your department stores, your clothing accounts, your Edgar's, your Mr. Price account. So it's similar to your revolving credit in that the store makes available to you a limit. So what you then do is you are able to buy on credit, or you buy whatever items that you're looking for on credit and then pay it back. And then once you've paid it back, you're allowed to buy again. So you're a revolver to a certain extent. So now you can actually argue that it's revolving credit, but the only difference is that there you're not given money, you're actually just given the opportunity to buy. So those are the three main types of credit, guys. And the minute we understand those, it makes life much easier, because now the next thing I then want to take you through is the difference between, the one thing that you need to understand is that all these credits charge you interest. That's no secret. We are charged interest, and interest is this taboo name for abantu abaningi. Not a lot of people really understand what interest is, but my job today is to explain it in layman terms, to explain it to a person or asekasi or who's running a spaza shop asekasi, who wants to borrow money from the bank. He needs to understand what the impact of him borrowing money from the bank is. He will be charged interest, but he needs to understand what type of interest is it, how does it work, how do I position myself to take advantage of it and to pay it off quicker. So not all interest is the same. You need to understand. So the two main types of interest that you get out there, guys, you get what you call compound versus simple. So you have two types of interest. You have interest that is compounded, and you have interest that is simple, right? And this, knowing the difference between these two, guys, makes a whole, I don't know how to call it, but it does so much to your understanding of finance. Because the minute you understand how to take advantage of the different types of interest, I promise you, Bob's your uncle. So let's explain it. Compound interest. A lot of people have heard the term being thrown around, but I've never really understood the concept. I've never really grasped the concept. Today I'm going to try to break it down for you as simple as I can. Compound interest is interest on interest, right? And what that means is that, so asi bheka so mangupha I 100 rand namhlanje, ne, ngithi kuwe ungibhadale back in 12 months time, but uzongibhadala back in 12 months time every single month. Like uzongibhadala in 12 months time, but in monthly. So after month 1 uzongibhadala, month 2 uzongibhadala, then at the end of the 12 months you'll be paying me my final installment. So I'm charging you interest on top of that, because the interest I'm charging you is to take care of the risk that I put in borrowing you the money. Because you understand that, guys, 100 rand namhlanje is not the same as 100 rand in 12 months from now. So there's what you call time value of money. So because of time value of money, the borrower, the lender, will then charge you interest, because he's giving you 100 rand today and you're going to bring it back in 12 months time, but that 100 rand won't buy him what it's buying him today. I don't know if that makes sense. So they charge you interest. So that's what interest is. But now this interest differs, right? So going back to the example, if you pay 100 rand and I charge you 10% interest, right? So meaning that in month one, you're going to pay me interest plus a portion of capital. So your capital, let's say, is the 100 rand. So 100 rand is the capital, let's call it principal. So 100 rand is your principal, and then on top of that, there's the interest and chachayon. So when I'm patala back, imalon patala back has two components. It has an interest component, it has a principal component, right? And that's always the case, guys. That's always the case. As long as there's interest charged, and you're paying it back with a portion of capital, i.e., the actual a part of the 100 rand, and you're paying it of the portion of interest. So, and those two together make up your installment, right? So, mind the interest that is calculated, if it's simple interest, they then calculate the interest on the 100 rand, on the principal. So, every single month, when you're paying back, when they're determining the interest of the patala, it's determined on the 100 rand and go pay on, right? So, month one, I'm gonna say 10% times 100. Divided by times 1 divided by 12. The second month, when I charge you interest at the second month, I'm going to go back again to the 100 rand. I'm going to say 10% times 100 times 1 divided by 12. Third month, so the interest is going to be the same all the months because I'm calculating it based on the same principle of 100 rand. That's simple interest, right? It's interest that is calculated on the initial principle. Then when you get to compound interest, it differs slightly. Now, same scenario, I've given you 100 rand, you are paying it back to me over 12 months, monthly, over the next 12 months, but now it's compounded. What that means is that 100 rand, the first installment is in month one. We're going to say 100 rand times 10% times 1 divided by 12. So it's going to be similar to, the first month is going to be similar to the simple interest. But now on month 2, right, they then take that interest that was calculated on the 100 rand for the first month and they add it to the 100 rand. So let's assume now that interest was, for argument's sake, let's say it was 10 rand. So now on month 2, I'm now going to say 100 rand plus the 10 rand interest in chachayo on month 1. Then I'm going to say times 10% of that divided by 1, times by 1 divided by 12. So compound interest is interest on interest. So you continuously adding the interest from the previous month onto there to determine what the following interest amount is going to be, and so on and so on and so on. So that's the difference between the two. And why you need to understand the difference between the two is because of this. Let me make this example, right? I love making this example. Let's say it's petama fruta two konamach right in front of me. Imaginary fruit, just imagine it. I've got an apple this side, I've got an orange this side, right? So I've got an apple, a nice green apple, and I've got an orange, right? That's an orange, guys. My drawing isn't the best, but that's an orange. So if I ask you a question and say, based on these two fruits, the ones in it by mekonamachi, this apple and this orange, right? What can you give me a conclusive decision to say on average? What is the bigger fruit? Are apples on average bigger than oranges or oranges bigger than apples? Based on these two things, the question is, can you make a conclusive or an accurate analysis based on just these two fruits that I'm holding in front of me to say on average apples are bigger than oranges or vice versa? Do you agree with me that that wouldn't be an accurate answer? Because you can get a situation where you've got a very big apple and a very small orange and vice versa. So what I'm trying to say is that the answer to which fruit is bigger, or in general, on average, which fruit is bigger between an apple and an orange, my answer to that is that it depends. Right? And why do I say that it depends? Because we need more information for us to actually make a conclusive decision, an accurate decision. And what I mean by that is that for you to really know on average, are oranges bigger than apples or vice versa, you would have to take a bigger sample. You probably have to take, a whole lot of apples and versus a whole lot of oranges, and then make a decision on average to say on average we've got these apples here, you've got these oranges here. On average, apples are bigger than oranges, or vice versa. So you need more information, right? So the same then applies with this scenario. You've got here 10% versus 21%. And then people always say, yeah, no, man, credit cards are expensive because they're 21%. You must never, ever, ever take a credit card if you have a choice to take a amortized instrument, or, something along those lines. So what I'm saying is that, for me, a lot of people make that assumption, but they actually don't understand why. They actually don't have all the information, because purely based on face value, we can't make a conclusive decision, guys. We need more information to know, is 10% really lower than 21%? For argument's sake, if I said to you, this is 10% compounded, and this is 21% simple, does that now change your stance? Do you still think that 10% is lower than 21%? Right? So what I'm saying is, guys, you need to read the contract, you need to read the terms, you need to understand in full what type of interest are we dealing with, because the type of interest you're dealing with has an influence on whether or not this is a cheaper instrument for you or not, right? So now, let's assume this is a situation where it's compounded over 20 years, right? This is your bond, for argument's sake. It's compounded over 20 years. You understand that the IRR on a 20-year bond at 10% could go as high as 150%. Now, if you have 150%, do you still think 10% is cheaper than 21%? You see, so the importance of understanding the differences between these two and understanding how to take advantage of those two, I promise you, it will change your world so much, guys. Like I say, Albert Einstein said, like, compound interest is the eighth wonder of the world. Those who understand it, earn it. Those who don't, pay it. You have to choose which side of the fence you want to be on. So, now that we've gone through that, I want to take you through how your mortgage bond works, or your mortgage bond works. I want to take you through that. But if you can understand how your mortgage bond works, you pretty much understand how all installment credit works. Mortgage bond is just an example, but like I say, you can apply it across board. So, and the reason why I want to explain this to you, because in next week's episode, in part 2, we now want to take on the concept of how to pay off your bond or 20-year bond, how you can pay that off in 5 to 7 years without overextending yourself. But for you to understand that topic or to understand that session, you first need to understand how a bond actually works, right? So if you remember, I said a bond is an installment credit. So under these three, it falls under installment credit. So how it works is, a bond is an amortized instrument, right? And all your installment credits are amortized instruments, right? And what that means is that it's amortized over the life of the instrument, right? And let's try explain that concept in a drawing. So, mortgage bond. So we're gonna make some assumptions here. My numbers aren't gonna be that accurate, guys, so don't judge me for that. So let's assume you have a bond, you've been granted a bond by your bank for 1 million rand at 10% and for 20 years, which is like your standard bond. You've been granted a 1 million rand and you're paying it over 20 years, which is 240 months to be exact. Months. Yeah, 240 months to be exact. That's your bond, right? So now, one thing that you need to understand is that with every payment, as mentioned, with every payment that you make, remember the installment that you make on this bond, out of, just for example, say it's probably going to be paying 10,000 rand a month, 10k a month. That's how much you'll be paying per month, right? So, what I want you to understand is that this 10,000 rand here that you'll be paying per month is actually made up of two components. It's made up of interest, which is the interest we refer to here, compound interest, and it's made up of principal. Right? So for every installment that you make, right, doesn't matter what type of credit it is, right? For as long as there's interest charged for every installment that you make, that installment is made up of two components, made up of an interest component and a principal component. That 10,000 rand is broken up into two, right? It's important you understand that because this next part here is very key. Then let's assume this is your amortization schedule. We've heard a lot of people talk about amortization schedule. So this graph that I'm going to draw here is your amortization schedule. And let's assume that this line here is payment. So let's say PMT, right? And then this line here is your month's time. So let's say time, right? And remember we said this is a 20-year bond. So here we'll have day one that you take out the bond, and here halfway we'll have let's say year 10, and then at the end where the bond ends we've got 20, right? So this represents amortization. So I'm actually trying to break down amortization for you in layman terms, and if you can understand this, I promise you'll understand a lot of things, right? So this is amortization. So remember we said we pay in 10k per month, right? So now the relationship that your bond is going to have is going to be as such, right? There's going to be this line here. This line represents payment, right? Together with this line here. So let's call this interest. Let's use a red pen. Let's call this line interest. So this is your interest payment, and this is your principal. Right? Interest, principal. So what this graph tells you is that with every payment, remember we said our payment is 10,000. With every payment on your bond or any other instrument that you pay, with every payment on your bond, right? For the first part, and remember this is the midpoint of your bond year. This is year 10, right? You're gonna first start paying off a chunk. A big chunk of your installments is gonna start paying off the interest, right? So pretty much for half of the first half of your bond's life, you'll be paying off your interest. I wanna see what happens. You're paying off interest mostly, and principal is slightly lower, and then it gets to a midpoint and where it basically breaks even, and then it changes the other way around. So if we saying that our installment is actually 10k per month, I kid you not, guys, about for the first half of your amortization, for the first half of your bond, about 9,000 per month goes towards interest, and about 1,000 per month goes towards the principal. I kid you not. That's why uthola a situation where you've taken a 20-year bond, and halfway down the line, 10 years later, umuntu expects to see their balance to have dropped down by half. So they expect that they owe 500,000 at the bank, and that's never the case. It's because of this situation, because the first half of your bond, you're paying off interest mostly, a big chunk of it. Obviously, it will vary month to month in terms of you know what I'm saying, over the next 120 months it will vary lapo na lapo, but on average you'll be paying a big chunk of it taking it towards your interest, and a big chunk of it or a smaller chunk of it going towards your principal. And now this part here, this is where the bank makes its money. So we call this bank profit. Right? That part there is a bank's profit. So that's amortization, guys. So you're paying off interest pretty much for the first half of your installment, or for the first half of your facility, and then you start paying off principal going on, because from this side here, then principal starts gaining momentum and interest starts losing momentum. So in short, what this is telling you is that the longer your instrument, as you go into the life of your instrument, you're paying less and less interest. It starts high, but it lowers. But the inverse works for the principal. the longer, the more you go into the life of your instrument, you're paying more and more principal. So, and this is where the bank makes this money. So what normally happens with most people, right? When they get here, because 10 years is a long time, guys. Let's be honest. 10 years is a long time. If if your daughter was born today, 10 years from now, she's in what, grade 5 or something like that. So 10 years is a long time. So what normally happens is that because you've been paying this thing for so long, and it's like, it's been a burden on you. You get to year 10, the bank says, well done, Mr. Calvin, you've been such a good payer. Stella or refinance, right? And then you get to this point and they say to you, listen, we'll refinance you, and what we'll do is we will lower your installment. We'll recalculate your installment, and you'll start paying us only 9,000. And you're thinking, damn man, that's a lot of money. I mean, an extra 1,000 rand, I can do so much with 1,000 rand. 1,000 rand is a lot of money. I can do so much with 1,000 rand. But what you don't realize that when you agree to this restructure, when you agree to them restructuring your facility to 9,000 rand a month, what you don't realize that you're actually resetting the clock. So you're taking yourself back to that point in time. So meaning that you've now just built onto this another 10 years. Obviously, it differs from time to time, but I mean, on average, you've actually just reset the clock by you agreeing to the restructure. And a lot of this is happening now with the COVID situation, people taking these reliefs and so on. A lot of them don't realize that they're actually resetting the clock, right? And you're adding more years to your instrument. But anyway, so that's pretty much your amortization. So the other thing I want to show you is that if this is my amortization, let's assume we're at the midpoint at year 10. Let's assume, so that means that total installments made. So you made total installments of, we said 10,000, we times that by 120 because 10 years is 120 months. I mean, so if you take 10 times 12, you get to 120. That gives you a total of 1.2 million. So you remember you took a bond, you're 1 million. That's another thing that you remember. Your bond was 1 million. Halfway down the line, you've paid, in terms of cash flow, the amount that's left your bank, you've paid 1.2 million. But now let's see that split, that 1.2 million, how it's split. How much of it is interest? Let's assume, I think we said 9,000 rand for the first half. So if 9,000 rand times, so we say 9,000 rand times that by 120 will give us, how much is that? By 120. Okay, my maths isn't that great. Let's actually do calculation here. So we say 9,000 rand times 120. We have 108. This is interest, right? And then we take 1,000 rand times 120, and that gives us 120,000. And this is principal. So in actual, what I'm trying to say is that in the first half, so at the end of the 10 years, the first 10 years of your instrument, you've paid 108,000 interest. You've paid 120,000 principal, and in total you've paid 1.2 million. So, meaning, guys, that your debt at bank has only actually decreased by 120,000. So you've been paying this thing for 120 months, but it's only decreased by 120,000. So meaning that at this point in time, if you had to settle your bond, at this point in time, you actually owe the bank 120 minus 1.2 million minus 120, which is, you actually owe the bank this. If you had to settle 10 years down the line, you actually owe the bank more or less this. Obviously, it will differ. like I say, I had to make assumptions, I had to assume, but on average, you'll pay more or less this if you had to settle 10 years down the line. Now, tell me, is that fair? Well, it depends. Do you want to be in this thing for this long? If you do want to be in it, then yes, it's fair. The bank is going to make money out of you. And you need to ask yourself, I mean, if at this point the bank has already made 1.2 million out of you, that means they've already made enough to buy a second property, right? They've already made enough. So you basically would have bought that property. And by the time you get to this end of this thing, I guarantee you would have bought 3 properties with that money. Because there's what you call a credit multiple, which basically talks to how many times the actual cash flow that you would have made to the bank, how many times that has bought you that property again, or how many times it would have allowed you to buy that property. So if we're saying that at this point in time, at halfway down the line, the credit multiple would be 1.2. So meaning that you would have bought 1.2 times that property that you financed, right? So at the end of the 20 years, your credit cost multiple will probably be what, 2.1, somewhere along there, somewhere along there, which essentially means that you would have bought the same property. You would have been able to buy the same property at least 2 times, right? So those things are all in your agreement that you signed, the quote, the agreement, the financing agreement that you signed with the bank. All of those things are there, but you just need to read them. And some of the times you see it there, but you don't actually understand, and no one is actually there to explain it to you. So it's my job to bring you that explanation, guys. So that's the relationship you're bonding, Yako. That really is. So the last thing I just want to take you through is show you how a credit card differs from this. Because remember, this we said is an installment credit type of scenario. This is how they calculate the interest, and this is the relationship. So quickly take you through how it's done with a credit card. So with a credit card, just draw a line and do it here. So with any revolving credit, right? Revolving credit works on what? Actually, let's do it on this side. So revolving credit. So revolving credit works slightly different. We'll actually have a more detailed session where I take you in detail how credit cards work and how you can take advantage of credit cards. For now, I just want you to understand how interest on credit cards is calculated and how it differs from the interest that's calculated on your installment credit, right? So with credit cards, you have what you call average daily balance, right? And so think back. Remember, I said that with a fixed, or rather with with an installment credit, they know from day one what interest to charge you. So interest is charged from day one because they know exactly what the term is going to be, the duration is going to be. With this, on the other hand, they don't know that information. They don't know how much you're going to use. What they've done is they've made available a limit for you, and then you can use the limit today. You can decide not to use it today. You can use it whenever. But the important thing to note here is that they can only charge you interest upon usage. So if you haven't touched the balance, they can't charge you interest. So they then use what you call average daily balancing. And how average daily balancing works is it says that if I've given you 10,000 limit and you use, let's assume you use 2,000 out of the 10, right? Then the interest I'm going to charge you is going to be 2,000 Rand, right? And we say multiply 21%, let's assume the rate is 21%, multiply by 21%. Then they're going to say divided by 365. And that's going to give you, let's say, quickly calculated. So if you say 2,000 Rand times 21% divided by 365, it's going to give you like 1.15, right? And that's the interest for day one, right? Average daily balance. That's interest for day one. Tomorrow, the same thing is going to happen. You're going to say 2,000 Rand times 21% divided by 365. Now let's assume Day 3, you pay back 500 of that 2,000. So you say you owed 2,000, but you paid back 500. So now you only owe 1,500, right? So meaning on day 3, what they're then going to say is, because remember, it's only charged on usage. So they're then going to say 1,500 times 21% divided by 365. And they'll give you whatever it is, let's say 1.06. And that's how much interest they'll charge you. And then what's essentially going to happen is that, so at the end of the month, they're then going to accumulate all of these for every single day. Let's say the 1.15 plus the 1.15 plus the 1.606, all of that for 30 days. And then they're going to get to a final figure of, let's assume it is 10 or 7 rand. So that's how much interest you're going to be charged for the month. That's how interest on revolving credit is determined. But like I said, we're going to have a more detailed session about credit cards and how that works. Today I just wanted to highlight you on that, because this again is going to be very key. It's going to be very important in next week's session, because when we now take you through how you can pay off your debt in 5 to 7 years, you need to understand how these various interests work, right? And if you can understand that, I promise you, Bob's your uncle, guys. There's so much that you're gonna take advantage of. So that brings us to the end of today's session. I hope you learned a lot. I tried to break it down to as basic as possible. But if kunalana ni clear, guys, I urge that you just throw the comments. I'm there to answer as much of your questions as possible. But please revisit this video again, understand it, and yeah. Other than that, don't forget to click the subscribe button, guys. Join us in this journey. Let's learn together. And yeah, this is our boy Kelvin, the Struck Investor. Until we meet again next week.